Good afternoon. I think, any session after lunch is the most difficult, but I'll try to make it more interesting. I'm not here to sell a product. Although what we do is a performing high yield credit by lending to real estate between 18 and 22%, which is very akin to what you heard in the previous session. But I want to share with you what makes real estate really interesting, inviting, and very attractive for investments. Direct investment in real estate is very close to each one of our, as Indians. You go to any Indian, HNI, ultra HNI, affluent, aspirational, everyone wants to invest in real estate for future. Because we have only seen a one-way journey of prices in the last probably 3 decades. There have been cycles in between. We have seen 90, 91, 92 as a bad period of real estate. We have seen 97 to 2002, which was not a very good period for real estate. In fact, nothing used to move in those 5 years. Everything was available at a discount. We have seen a short blip on 2008, 9, 10. And then the downward journey of real estate we have seen from 16 to 2020. And after that, obviously, the recovery has been like a hockey stick. So I want to share with you what is right with the sector now, which was not right earlier. I think first thing we have to understand that this sector got regulated in 2017. So 2017 is to real estate what it was to equity in 91, 92. Because sector got regulated, equity was actually regulated, PMS regulation came, and many more regulations followed. So 2017 is to real estate for our country what it was to equities in 91, 92. I think I will share with you some data points on why it makes attractive today and why will it attract billions of dollars, as is very evident from the foreign institutional sector, which is taking interest in this particular sector. I think if you look at this absorption versus new supply in the last 6-7 years, you will notice that post-COVID, the absorption has been more than the supply, which has resulted in inventory overhang. An inventory overhang is under construction, unsold properties divided by last 4-quarter average sales. So if you will look at post-COVID or during the year of COVID also, because the supply had dropped, the absorption has kept on increasing and it is more than the supply, which has resulted in an under construction inventory which used to be around 30 months has come down to average 10 months in the top 7 cities in the country. And I'm only referring to the multi-storied constructions. It is not of plots or individual villas being constructed by individuals. The second thing is we have reached the highest absorption in 23 and that trend continues. But if you go back to the history, when the sector was regulated here in 2017, we had a second home tax benefit. So each one of you used to take 2 home loans, rent at 3% yield, the 6% negative yield, because home loans used to be at 9%, were allowed to be set off against our salary income or business income. That benefit was withdrawn in 2017. GST was introduced in 17, so under construction properties became more expensive by 5%, 6% GST. 11%, you are negative day one if you are buying houses for investments. Your rental yields are 3%. Your opportunity cost is more than 6-7%, and your home loan rates are 8 to 9%. So it never made any economic sense to buy a house for investment. But why it worked in India? Because prices went up continuously for the last 30 years, but they have gone up in phases. In 16 to 20, there was no price increase. In 21 to 24, there is a 100% price increase or 30 or 40% price increase, which is a catch-up of the last 7 years. The timing of buying a house is very important. When you get value in distress. You get only in cyclical times. But as an end user, if you are buying your first home, then you never have to think about it, and you have to buy that house because you are buying for self-use and not for investment. The second part which is important is that I remember 2011 data, if you pick up, the NCR data used to look like MMR. And today, exactly 13 years, MMR is the highest selling in the last 4 years, from 1,24,000 to 183 is the number of units being sold in MMR. And NCR has dropped significantly because there is no supply. And that market has consolidated because I think 7 out of 10 players there have vanished because of the either being bankrupt or because they overborrowed, overcommitted, and that is why the number of players have reduced. And the supply has also reduced because there was no land supply in Noida, which was added in the last 6-7 years. Bangalore continues to be very stable, growing consistently. What I have seen, and I must admire the understanding of the IT sector employees, they are never euphoric. They understand there is sanity in that market. The prices have not gone up like you will see pockets in NCR where Gurgaon has grown by 100% in the last 3 years. So is the situation with Noida because there has been no supply, or the supply is dominated by players who can manage to increase prices because they have a differentiated product like DLF listed player. So we have seen Pune catching up because Pune is firing on all cylinders. Manufacturing, IT, weather-wise, defense, it is a retirement hub. Anyone, you pick up anyone from North India or South, and I give them an option where you want to settle down as a retirement place, he will say either Bangalore or Pune. So Pune is very consistent. Hyderabad is what is Chennai's loss is Hyderabad's gain. Chennai has lost on migration, and that is gain of Hyderabad, and they have delivered a very good infrastructure and a red carpet welcome to IT companies, and that is what has delivered very good sales in Hyderabad. And this is actually one slide which I show to every investor I meet, and I am sharing this to you, and please keep this in mind. We had an under construction, unsold inventory of 37 months in MMR, when NBFCs were very active from 11 to 17, because they thought, what banks cannot do, let me borrow from banks and do it. So they started lending very aggressively to the sector. And the supply increased, 49 months in NCR, 29 months in Pune, 28 in Bangalore, and 32 in Chennai. And when the NBFC crisis came because of ILFS in 30, all these NBFCs went for a toss. And the end result was 11, 10, and 8 months of supply today. But yes, this supply is also, you have to keep in mind that the last 4 quarters has been the best performing sales. But now the market has turned from an investor-driven market to a user-driven market. GST has been introduced. Second home tax benefit is gone. NBFCs have stopped lending or slowed down lending, and number of players have vanished. And we are now in a situation where the inventory overhang is very, very low. Yes, in the last couple of quarters, many players have started buying land because they see the consolidation happening in the sector, like any other sector. And this is a story of consolidation. This is the data of 13 listed players whose market share has gone up from 9% to 15%. These are only listed players, and these are like DLF, Shobha Brigade, Macrotech, which is Lodha, and many more. These are 13 listed players. And these are top 34 players, including the listed players, whose market share has gone up to 26%. So, like any other sector, consolidation is happening in this sector, and the big is becoming bigger at the cost of the smaller players, unorganized players, those who have not delivered to the customers, and that is the end result of this consolidation. The other part which is worth sharing is that office real estate, and look at, you saw the residential data, where absorption was more than the supply in the last 4 years. And you have this, the residential data, and this is the office data, where vacancy is increasing, and the net absorption is either less or equal to the supply. So on the commercial side, it is a different. Because of cloud, because of COVID, because of work from home, the vacancy is higher, especially in grade B and grade C offices, where we are seeing people are more interested in grade A offices. Retail side, it is the other way. Retail malls, people had stopped entering into that business because of a bad period of retail real estate. But now we have a situation where the absorption of retail is far more than the supply. And that is why the first REIT which has happened in the retail space is doing much better than the office REIT. The money is coming to the real estate sector, but somehow, because of legacy, past track record of players who have not delivered, the money is only coming to the office sector or to the logistic or industrial warehousing space. It is not coming from outside to the residential space. I think I won't take too much time on this data anymore because I have been given a timeline. All that I want to share with you is, when the sector gets regulated, when consolidation takes place, and today how many players are left in the high yield performing credit space in the real estate? These are hand counted 6 players. HDFC and Kotak, those who are not dependent on domestic money, they borrow, they have investors from outside. And there are 3-4 players, including us, who are left. Those who have a track record and pedigree of 16 years, 20 years. If you analyze their track record and see the size of the opportunity, when banks and housing finance companies, and we have a regulatory advantage because banks and housing finance companies cannot lend to the sector for buying land. They cannot refinance that. The tenure of the loan, if you have taken from any regulated entity, which is bank, housing finance company, or NBFC, and you want to switch over to anyone, you cannot change. The size of the opportunity on the performing high yield credit, like what was being discussed in the earlier panel discussion, is very, very large. And all your investors and you should study this space and advise your customers. Only when you are slightly contrarian and you enter into a counter-cyclical opportunity, you make money. Like, for example, if somebody bought a house in 20 or 21, his house has definitely doubled. But if I bought a house in 18 in Mumbai, and even if it is doubled, my IRR is very, very, very negligible. So it is a cyclical business which is linked to the interest rate cycle. But I compare Indian residential real estate also to all other markets. If you go to all developed markets, you will notice that their mortgage to GDP, all outstanding home loans, as a percentage of GDP, is anything around 60% in US, 90% in Australia. But our mortgage to GDP is 11%. You can go and buy a house anywhere in the world, including US, Singapore, London, but no foreigner can buy residential real estate in India. All those economies give incentive for buying a second home, third home. And that is why their mortgage to GDP is more. Their economies are driven by attracting investment in residential real estate. Our economy is not driven. In fact, our regulator is the most sensible regulator who does not allow banking and institutional money to go to this sector. And because it is a counter-cyclical opportunity, you should examine why your investors should not look at this space. Because people are not looking at it now. When there will be a herd, and then it may not be the right sector to look at. With this, I would like to thank you for a patient here listening. If I have bored you, I can meet one-on-one and make it more interesting.
Absolutely not, sir. Thank you so much for giving us so much of clarity on opportunities in real estate.